So let's have a quick recap then of what we did on PPE. First of all, we said, when can I bring PPE into the accounts? And we said, well, it has to pass 3 tests. The first test meaning we have to control it. The second test being we have to have probable future economic benefits. And the third test being that we needed a reliable measure. Then we went to have a look at, say, right, okay, well, what do I put onto PPE cost then? And the first thing was obviously the purchase price. The second thing was any directly attributable costs, for example, postage and packing, site preparation. Directly attributable, meaning we wouldn't have had to pay it otherwise, and it's for cost to bring it into its, get it to work and to bring it into its current location. And then other costs we looked at was any future costs, and we said that future costs need to be brought in at their present value, and the double entry for that would be debit PPE with the present value and credit liability with the present value. And then what we had to do at the end of each year with that liability is we had to unwind the discount, and the unwinding of the discount would be debit interest and credit liability each year. Okay, now I'm looking at just one final thing that could go on to cost, and that is any borrowing costs. That if they are directly attributable, we might be able to add on some borrowing costs. So let's have a look then at borrowing costs in a little bit more detail. First of all then, obviously borrowing costs is basically interest, isn't it? Pretty much. So interest normally goes to the income statement, but what I'm saying is it can go on to the cost of PPE instead. So instead of debiting income statement, you debit PPE instead, but it needs to be, excuse me, a qualifying asset. Okay, it needs to be a qualifying asset, and all a qualifying asset means is something that takes a while to build. Okay, so it's while we are constructing something that we can add on interest. Okay, so if we get a loan to construct something and that construction takes a while, then the interest on that loan can be added to the cost of the asset. So first of all, there's 2 things you need to be aware of. Okay, and that's that you could have a specific loan for the asset, or you could just use your current borrowings. And the thing that I want to make clear, if you're using a specific loan, use the interest rate. So if it would be a 10% 4,000 loan, then your interest would be based on the 10%. With your current borrowings though, you might have a 10% 2,000 loan, you might have an 8% 6,000 loan, you might have a 4% 1,000 loan. Who knows what you might have in your current borrowings? And so what you've got to do is you've got to use the weighted average, okay? And that will more than likely be given to you in the exam. What is the weighted average costs of all those? Okay, so specific loan, just use the interest rate. Current borrowings, use the weighted average of all your interest rates, which will probably be given in the exam. And you can only do this for an asset that takes a while to build. So the next thing I want to have a look at with borrowing costs is, first of all, when do we start adding the interest to cost? Okay, when do we start adding? And it's the end of BAE. So borrowing costs have already started, i.e. you're already paying interest. Activities, so the constructing must have already started, and you must have already have been started or starting on paying expenses. Okay, and it's the later of all these 3. Okay, so when can I start adding interest to cost? Once the later of all those three. So basically once all those three have already begun. So I'm already paying borrowing costs, I've already done some activities, and I've already started spending money. Okay, next question then, if that's when I start, the next question is, when do I end? And you end when it is not complete, but substantially complete. Okay, so as soon as it's virtually finished, then you stop adding the cost, the interest to the cost. Okay, and any interest after that would just be put to the income statement. So it's really from here to here is just the construction period. That's when you can add the interest, goes to the cost of the asset. Anything before, anything afterwards, interest goes to the income statement. Okay, hope that's clear. So the next bit is then, how do I calculate this amount? All right, how do I calculate that amount? Right, let's say the asset cost is 4,000. And so I go out and I get a specific loan of 4,000. And in year one, I spend 2,000. In year two, I spend 1,000. And in year three, I spend the final 1,000. But I get all this specific loan right at the beginning. And this loan is costing me 10%. Okay, so hopefully you agree the cost to me, I get the loan, I get the full loan at the beginning. Okay, I don't get a loan for 2,000 and a loan for 1 and a loan for 1. I get a loan of 4,000 at the very beginning. So it's going to cost me 400, 10% of 4,000 in each year. Okay, that will be my interest paid. But I will have also some interest received. Okay, and that's because any money that I don't use, I'm going to put in a deposit account. So I can now tell you that the deposit account is paying me 8% interest. So how much interest will I receive in year one? Well, I spent 2 in year one, which means I've got 2,000 left over, which I will put on deposit at 8%. 8% of 2,000 is 160. In year two, I will have spent 3,000, which means I've only got 1,000 left. 1,000 at 8% is 80, and in year four, I've spent it all, so I've got nothing to put on deposit, so I've got that. Now, how much do I put into cost then? Well, what I put into cost is that. 400 paid, 160 received, 240 goes to cost of the asset. Here, 400 minus 80, 320, and here, 400. That's what goes to the cost of the asset, okay? These figures down here. Finally then, that's with the specific loan. Now let's have a look how this changes if we use our current borrowings. And let's say our current borrowings have a 9% weighted average. Remember, I'm not getting a specific loan. I'm not getting a loan now. So in year one, remember I said, look, I said I spend 2,000. Well, I'm just going to use my borrowings for that. So I'm just going to use the 2,000. So the cost is simply 2,000 times by 9%, 180. In year two, I spend 1,000. So that is simply 9% of that, which is 90. In year three, I spend 1,000 on my 9%, 90. And they're the figures, not these figures up here. These figures down here, when I use current borrowings, they would get added to the cost. Okay, so that's pretty much it. There's quite a lot going on there, so make sure you have a look at all the next mini sessions, have a look at all the examples, work through. If you're struggling, go have a look at the textbook as well. There's more videos on this. Okay, but that's it, and yeah, I'll see you on the other side.